This is Scott Becker with the Becker Private Equity and Business Podcast, as well as the Becker Business Minute Podcast. This is today's report on jobless claims in the stock market, and thank you for listening. So new jobless claims came in this morning a little bit higher than expected. And this is what we would think of as bad news for jobs, bad news for signs of a recession. It was the first upward trend in jobless claims now in 5 months. The flip side of this is that anytime there's an uptick in jobless claims or sign of recession, it gives the market hope that the Fed will slow down in their hawkish efforts to raise interest rates. So what you see is sort of any news of jobless claims ticking up or employment not growing as quickly as it was causes people to be more comfortable the Fed might not act as aggressively as they would be. So what this leads to in terms of the stock market is as follows. The market's relatively flat today, relatively flat yesterday after a serious sell-off 2 days ago. The serious sell-off was triggered by Fed Chairman Jerome Powell testifying to Congress that they thought more rate raises were needed to slow down inflation and slow down the economy. So this led to the markets dropping. The S&P dropped to 1.5% on Tuesday, relatively flat yesterday, relatively flat today. And the reason it dropped so much was the belief that Fed Chairman Powell thinks we need to keep on raising rates, and the Fed will keep on raising rates, and that will tighten the economy, sort of quantitative tightening versus quantitative easing. So where does this leave us now? Relatively flat days in the markets today and yesterday, and really waiting on tomorrow. Tomorrow comes out the jobs report, which reports on how many jobs were created in the month of February. January ended up being a much bigger job creation month than expected. This led to thoughts that the Fed is going to tighten further, raise rates further, and led to the market slowing down significantly after a good run-up in January. So we've given some of that back in February. So now we're waiting for that report tomorrow. And depending on how that report comes out in terms of new jobs created, if that comes out again higher than expected, you could expect the market to react very negatively. If it comes down significantly, we're expected lower than expected. We'd expect a flat day or an okay day based on projecting that the Fed's not going to have to act or won't be as excited to act as aggressively to tee up more interest rate hikes. I mean, either way, everybody knows. I think people know March 2021, the Fed's going to raise rates again by 25 basis points, but they may raise them by 50 basis points if their signs are that the inflation is too hot and heating up too much, and the job market's too hot and heating up too much. In any event, thank you for listening to the Becker Private Equity Business Podcast and the Becker Business Minute. Thank you very much for joining us.